What's up, everyone? It's Caddy with Money Investing. So a little bit unusual for this timing of the live stream, but let me know if in the live chat if you guys can see me and if you guys can hear me without any problems. So we got 2 p.m. when they're actually reporting the statement, and then at 2:30 is when we have the live conference. That's what I'm going to be streaming to get a good understanding on. Yes, I did just wake up. I did go to bed for a little earlier, got some rest for a couple hours, and then woke up again. So yeah. All right, good. All right, perfect. So we got the Nasdaq that's up over 40 basis points so far, huh? I woke up and looked at AMD. That was actually a strong move to the upside here, breaking past over $97. That was surprising. A lot of volatility for AMD stock, and you'll notice that we're up over 6.7%. 97.84 is the high for the day, and the all-time high, of course, it's well past over $99. So we're seeing that breakout over 95 today, right? That's a pretty strong move to the upside. So still watching $99 as the next resistance for advanced micro devices. All right, so it's 11:29. We got about 8 seconds left. Let's see if we actually get that statement from the FOMC meeting's website. It should be released at 2 p.m. as far as I knew, and then we'll kind of circle back to the press conference at 2:30. All right, so the service is unavailable now, but doing the reload. All right, there it is. So we got the PDF. What I'm going to do is I'm going to actually put together the S&P 500 here, and the Dow. Well, we'll keep a close eye on the markets here, and the Nasdaq as well, if we continue to kind of slide over. But this right here is the actual statement. All right, so the Federal Reserve is committed to using full range of its tools to support the U.S. economy in this challenging time, thereby promoting maximum employment and price stability goals. Remember, the Federal Reserve controls the monetary policy, so that's what they're really trying to focus here is price stability, which is inflation, and maximum employment. Those are the two big goals that the Federal Reserve has. So the progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. The sectors more adversely affected by the pandemic have shown improvement but have not fully recovered. Inflation has risen, largely reflecting transitory factors. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. So the path to the economy continues to depend on the course of the virus. Progress on vaccinations will likely continue to reduce the effects of the public health crisis on the economy. The committee seeks maximum employment, inflation at the rate of 2% over the long run. And with inflation having run persistently below this longer run goal, the committee will aim to achieve inflation moderately above 2% for some time. So pretty much the same language that they have told us. So the committee decided to keep target range for the federal funds rate at 0.25% and expects it will appropriately to maintain this target range until labor market conditions have reached level consistent with the committee's assessment of maximum employment. So pretty same language. I mean, there's nothing changed from what we have seen in the past, and they will continue to increase its holdings in the Treasury securities by at least $80 billion per month, and agency mortgage-backed securities by at least $40 billion per month as well. So again, this right here is going to be the Nasdaq on the side, if you guys can see that, up 50 basis points, trading past over 14,700. Since then, the economy has made progress towards the goals. The committee will continue to assess progress and in the coming meetings, and these asset purchases help foster smooth market functioning, accommodative financial conditions, and thereby supporting the flow of credit to households and businesses. So again, doing $120 billion, so $80 billion here per month in MBS, that's the mortgage-backed securities, and $40 billion per month in and other U.S. Treasuries until further progress has been made. Right, so in assessing the appropriate stance of monetary policy, the committee will continue to monitor implications of incoming information from the economic outlook. So, all right, the Federal Reserve voted unanimously to establish the interest rate paid on reserve balances 0.15% effective July 29th. And as part of the policy decision, the FOMC voted to authorize a direct open market desk at the Federal Reserve Bank, New York, until instructed otherwise, to execute transaction in the system open market account in accordance to the following domestic policy directive. So again, nothing changed overall for the most part. That was pretty self-explanatory anyway, because we weren't expecting like drastic changes, because just based on one inflation reading that we saw in the month of July. So that was for the month of June that we got earlier this month. So yep, so it's the same old narrative, but we'll get some more color as to what they really mean by some of those things. And of course, when the analysts and other people ask questions from Jerome Powell at 2:30 after the briefing, then we'll have some more idea as to what's going on. But take a look at the markets here. So we just bumped up a little bit. So if you go over to the 1 minute chart, you'll notice that we did get a little bit of volatility spike here. So for 1 minute chart for both the S&P, the NASDAQ, you'll notice that we got like a little bit of a knee-jerk reaction. We came down and then whipped right back up to over 14,700 for the NASDAQ, and for the S&P back up to over 4,400. So did get a little bit of a buying pressure here right after this report. So the S&P is pretty much flat on the day so far, and the NASDAQ now up over 60 basis points, with the Dow also catching some bids, down only 25 basis points, but almost an identical push to the upside for the Dow as well. So we got 25 minutes to spare. We will be going over a couple different stocks. Let me know if you guys can hear this. So just let me know if you guys can hear right here. Alright, so let me know if you guys can hear this.
Conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
Can you guys hear
And
me?
we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at Federal.
Alright, great. We'll check back at 2:30, but alright, looks like the markets are now starting to pull back. But yeah, overall, I think it was a pretty standard statement. Nothing that we haven't seen before. Still keeping the federal funds target rate at between 0.25 percentage points, so keeping interest rates low. We, of course, didn't expect any type of a drastic change, but tapering. That's going to be the bigger question, is going to be when are they going to wind down on those $120 billion asset purchases, and when we're going to see those pull back, right? Alright, let's take a look at gold. Is it dropping all of a sudden? Well, it's only down about 14 basis points. So this right here is from our previous analysis. We had that resistance at close to 1825 or 1827. So we're getting rejected at that 200 SMA. I'd watch the 1750 level as the next level to watch as a support for gold. So we got a perfect balance higher from this double bottom support here. So we rallied, I think, over 9%, over 14% for gold prices. Then got tapped out at 1915, and since then we actually sold off, pushed higher, got rejected at the moving averages, and sold off even further. All right, let's take a look at Amazon. Pretty much flat on the day, and down about 2 basis points here. So trading as low as 36.25, but that right there is going to be a support level at 35.60 levels to watch from Amazon. But really what I'm interested in today is going to be advanced micro devices, right? We literally talked about this stock yesterday, and I broke down a video going over the earnings. I still have to kind of listen in on what Lisa Su basically talked about in terms of the future guidance and everything related to product lineup and different things that weren't in the earnings report and the numbers. So I'll be doing that over the weekend. But all in all, I mean, the earnings report were fantastic for the company, and I think it warrants this upside as well. A lot of stocks actually turned very, very green today. So you'll notice that Baidu is up over 5.2%. Alibaba's up over 4.6%. So definitely pushing higher after the sell-off that we have seen recently. Then we got NEO that's up over 4.2. That's going to be these charts. So NEO holding above $41 pretty nicely. We got DraftKings that's up over 3.5%. We got Mara that's up over 3%, so not as much as earlier, but still up on the day. And then for the most part, I mean, it's green markets for tech and for growth stocks. And then let's take a quick look at some of the Dow 30 companies. And we've got McDonald's that's coming down. Did McDonald's report before the earnings? I think they may have reported the earnings already. Let's see. Alright, there we go. So McDonald's posts higher second quarter results on double-digit comparable sales growth. So, alright, McDonald's Wednesday reported adjusted EPS of $2.37 a share in the second quarter, up from 66 cents a year ago. Analysts polled by Capital IQ were $2.12, so higher than expectations. Revenue increased to $5.89 billion from $3.76 from a year ago. Expectations were $5.57. So top line revenue beat, bottom line EPS beat, and CEO basically mentioned, and I quote, "Our performance is a continued demonstration of the broad-based strength and resilience of our business, as global comp sales in the second quarter increased nearly 7% over 2019." So strong beat, and the stock is down about 2.5%. The next support to watch is going to be at 238 for McDonald's. And then we got a lot of companies like Facebook, PayPal, Shopify reporting their earnings after the close. So I would keep a close eye on Shopify. I do expect some more downside, unfortunately, considering that it's been hitting new all-time highs. Very similar to PayPal, it's been going higher, and Apple as well. It's just been running up over 60% in the last 6 to 8 weeks. So I would not be surprised to get some more pullbacks and a correction for Shopify even further down. But look at the markets. We are getting a little bit of a volatility back and forth, right? This right here is the 1 minute chart. You'll notice that we sold off, pushed higher, pulled back, and now we're starting to push higher once again. Alright, let's go over to the comments here. Let's see how many people we have watching. Alright, good. So if you guys don't mind just dropping that like button, it really helps out, and subscribe if you're new here to the channel. We talk a lot about the macro analysis, fundamental analysis, and technical analysis, like all three things combined together. So if that's something that you're interested in, and if you want to learn more about those things, then definitely make sure that you subscribe. Alright, let's take a look at. So what's your take on S&P biotech stocks? I think there is going to be some time until it actually catch some bids here, but this right here has been a strong downtrend for XBI, right? From our all-time highs, we're still off the highs 28% from all-time highs. The RSI is oversold, the MACD is oversold. I do expect a recovery from the biotech sector, but hey Aaron, what's going on? Thank you so much for joining in. I appreciate it. But I do expect that to happen once the broader markets start to basically, well, it's kind of a weird sort of situation because it's underperformed the S&P, the Nasdaq. Like they have both rallied. More specifically, the S&P has rallied to new all-time highs, and the biotech sector has consistently just sold off. So there is potential in this sector, but just be mindful that you may not see the gains right away. You may have to be very, very patient in this sector for it to really take off. A very simple example is ARKG. Like it's kind of like in the same space, and you'll notice that we're off the highs, down 26-27%, almost an identical drop from our all-time highs for the biotech sector. They're kind of like in that same category. Genomic Revolution ETF also has a lot of names that are probably in the biotech space. So I am bullish over the longer term. I think this is a very, very promising sector, but we'll just have to be kind of patient with it. It's just one of those things where tech and biotech will kind of like underperform the markets. It's like the S&P 500 will be like this. It'll keep going up, and these sectors will kind of like stagnate and basically trade sideways, and then it'll be like a couple years where they'll just like have parabolic growth, and they'll like meet up with the S&P over here. So like they'll underperform the markets for a couple years until the potential for these companies is fully realized, and then we see that exponential growth to the upside. And that's like most of Kathy Wood stocks and ARK Invest stocks, is that they don't take it year by year. Like most fund managers do. They don't care about the performance on a yearly basis, but they rather care about it over the course of the next 3 to 5 years. And they're more than fine with like underperforming the markets maybe today or tomorrow, but they are expecting that exponential burst for these companies to fully realize their potential and move to the upside. So I do think there's plenty of upside here in my opinion, but it's just that it'll take time. So we have to be very patient, and what's that opportunity cost to you investing in the biotech space versus something else. So I hope that makes sense, but still plenty of upside of a little bit over 38% if you do retrace back up to all-time highs. But there is a support at 120 to watch for this one. Supreme Master says you look tired. I am tired. It's a little bit almost midnight over here. So we'll be doing this for maybe an hour and 15 minutes, and then I'll probably get to bed like at 1:30 in the morning, and then wake up and then do the market updates. But yeah, it should be like about an hour long press conference. It usually is about an hour long, because there are some questions there as well. So we'll get it done for the most part, and then keep a close eye on the broader markets as well. So I'm actually gonna keep this like that. All right, let's take a look here. Yeah, so we're gonna keep it like that, and then we'll keep an eye out on the markets as well. All right, let's take a look at Nvidia. Let's see what's that doing. And again, the press conference starts in about 15 minutes, so we got time. So Nvidia, we got resistance at 209, up another 1.69%, bouncing off of that 50 EMA. The other side of the MACD look good, it look good. It looks good. So if you get a bullish crossover and the RSI pushes higher, we could see some more upside here for Nvidia. But just be mindful of the valuation. You're paying a little bit of a premium here for Nvidia stock. So I'm personally not going to be touching this at these levels, unless of course it comes down a little bit more. All right, let's take a look at Lucid Motors. So down about 24 basis points, but that right there is still going to be the range to watch for Lucid Motors. What do you think about PayPal earnings going to be? I've actually posted a video on that, and we also covered it during our morning live stream, so you're more than welcome to watch that to get a better estimate of what I think PayPal is going to report for their earnings. I think it was, last time I checked, it was a little bit over $6 billion if I'm not mistaken for their earnings. But alright, so I have it open. I'll just quickly go over it. So revenue, I'm expecting just over $6.4 billion and EPS of $1.30 per share from PayPal. But yeah, Microsoft is pretty stable right now, just hovering over 284. That's the support level that we're going to be watching, at least in the meantime, until after we see a more bigger pullback or a correction from Microsoft. So all right, let's take a look at Skills. So let's see where that's trading. Skills up 1.37%, but now once again trading below the moving averages, trading in between this wide range that we have seen for Skills. 23.90 is going to be the resistance, or $24, and the support sitting at 12.50. We've had a couple times we've bounced off of that level. So I'd wait for, again, it really depends on whether you're doing this as a swing trade or a long-term investment, but swing trade, I'll wait for an ideal entry at closer to 12.50. In my opinion, that's going to represent a better low-risk, high-reward trade-off. Considering the RSI is oversold, the MACD is oversold, I could see Skills kind of have a minor run-up higher to push us back up to over $17 or $18 a share. Considering that that's been the trend historically, every time we've come down to 12.50, we've seen a bounce back higher here, 75% jump, this right here, 100% gain. So I don't see why this time would be any different if you're patient enough to see that pull back down to 12.50 levels. But yeah, AMD having a killer day. It is. We talked about it yesterday. They had great earnings. So super excited about that. Waiting for 100 plus price tag on the stock. My target still is at 110, at least for the time being, and then we'll kind of reassess where that stock can potentially go. But yeah, a strong move to the upside from Advanced Micro Devices, almost at $98 right now. Very exciting. Yeah, so we got 11 minutes left for the FOMC conference, and hope you guys are excited. So we'll see if they're gonna taper or not. You sound mad tired. Just gotta wake up. Should have made some tea in the morning. I should have been able to talk much better, you know. But all right, let's take a look at Pubmatic and let's see where that's trading. All right, 32.70, 32.75. So we actually broke down below this sort of resistance. So we actually had an inverse head and shoulders pattern that we talked about earlier. Left shoulder, head, and a right shoulder. Like this is an inverse head and shoulders pattern, and then we saw a breakout from this resistance up to $44. Oh, Timothy, it's 2:20 a.m. Where are you based out of? You're probably even more west, east than I am. If it's like almost midnight here, so I'm curious to know where you're based out of. If it's 2:20 a.m. where you're at, Singapore. Gotcha. Okay, that makes sense. But $44 is going to be the resistance, and of course now this level is going to turn into a resistance as well. And we got the 50 exponential moving average aligned with that resistance right there. So that's the yellow line you guys see on the chart. But now it's just consolidating sideways. I think it's still pretty shorted. It's still shorted pretty heavily. And support level I'm going to be watching is going to be all the way down here at closer to $27. Anything in between that range, 27 to 38, in my opinion, is a good deal for Pubmatic because again, growing revenues, they're in the SaaS space and they have growing margins, profitable company. So I think it's got a lot of potential over the longer term. But the price pressure is of course coming in from additional shorts and the short interest staying pretty elevated for this company. So $27 support, $38 resistance, all the way as $44 for Pubmatic right now. So all right, that's that. Let's take a look at the markets here. The Nasdaq still up over 60 basis points, and we got S&P up over 5 basis points now, so turning green, and the Dow is slightly down about 27 basis points. So you got 9 minutes left. I'm gonna actually just keep it on the broader markets now, and then break down stocks if we have any energy after the press conference to talk about some additional stocks. But the VIX coming down once again, 6.4% on the day, trading is with 18, and the VXN is. So Ford. Did Ford report before or after the earnings? A lot of companies actually reported before the market opened. But Ford has been pulling back. It's been selling off as well. I'd say like this is almost an identical pattern to what we have already seen. So for Ford, you'll notice that we were making lower highs, lower lows here. So if you were to kind of identify that here, it's almost an identical pattern that we're seeing for Ford. So, and if you were to kind of identify this higher low trend line, you'll notice that we are kind of bouncing off of this support as well for Ford. So we kind of bounced off of that level several times here. So that was perfect validation here, perfect validation here, perfect validation a couple times here and here. And you'll notice that we are right now kind of retesting that support as well. So there's a higher probability that we see a bounce back higher from this level and eventually see a breakout back up to highs of 1562 or even as high as like 1645 for Ford. So I'd watch that support very closely. The RSI of course has come down, the MACD's come down. So there's a higher probability for us to see a breakout to the upside for Ford and make some moves to the upside. If we can get that breakout over that 50 exponential moving average right there at $14. So like look at the high for the day, $13.99, right? So we need to see a breakout over $14 to get some more upside for Ford. And there is plenty of upside here of close to 18, almost 19%. The RSI is pointing towards it, the MACD is pointing towards it, so we'll see if we actually get that breakout or not. But the markets here, the Nasdaq really starting to push higher after that statement. Maybe that's the market's way of expecting some more transitory talk from the Fed, and of course keeping interest rates lower, tapering basically non-existent right now, and until they give us any further notice. That just goes to show that there's more quantitative easing, right? There's more QE for the markets to rely on until we actually get to a time when they start tightening by raising rates. That is probably what the market is pricing in right now, but we'll see what Jerome Powell says in about 6 minutes. So, all right, what I'm gonna do is I'm gonna keep this here. I'm gonna probably do like this. You guys able to see that? Or should I make it bigger, like here? That should be fine, right? So we'll keep that over here, and then we'll keep the markets right there. And then we'll see how the reaction's kind of getting priced in to the markets. I don't expect like too much volatility. Maybe like the VIX goes up a little bit, up to, so this is the VXN. Maybe the VIX goes back up to like 19 levels or something, but I don't expect like too much volatility. They're gonna continue to like address the readings. Like if I quickly go over the inflation numbers from the month of what is it? From June. So this was actually reported in July. So in the first week of July, you'll notice that we actually saw a significant increase, right? This is actually the all items CPI, 5.4%. That's where we're sitting, from 5% to 5.4. So that was the increase for all items, but then you take out food and energy, that's the core CPI, that's also sitting at well over 4.5. So that is like a 29 or 30 year high. I forgot what it was like, but it's a multi-decade high for inflation numbers. And then of course all items, I think the last time you saw these levels was back in like 2008, 2007 right there, 5.6 and 5%, like right around those levels. So definitely, I mean, for them to acknowledge this, it's going to be super important, but what they do about it is going to be even more important, and how they combat rising prices, because they're going to get a lot of questions that I feel like are just going to be straight up, you know, what are you doing? Like, inflation is going up so much, and you know, prices are running higher. And I know Jerome Powell is going to continue to kind of beat his drums on the transitory story, which is fine, because the used car prices have been the real reason why we've seen prices move up so much. Charge points running. Let's take a look. By the way, charge point was part of our swing trade idea here. So again, if you guys want to get those swing trading ideas, real-time buy and sell alerts, the Patreon link is going to be down in the description below. That's going to give you access to the private Discord as well for our community. So AMD $100 today, we'll see. Probably it's possible. It is very possible for us to see AMD at $100. All right, I just want to make sure that everybody can see this and we can hear it as well. So I won't be talking much during the entire press conference. We'll just be looking at the markets and then take a look at how everything's trading. And then I'll kind of share my thoughts after it's over. So we'll just keep it like that. And we'll actually remove the Dow from this. Yeah, I'll turn it up in just a second. The conference is usually about an hour. His briefing is going to be for like the first 10 minutes or 15 minutes, and then it's going to open up for questions. So we'll keep a close eye at the S&P here. This is the S&P's 5-minute chart, and this is the NASDAQ 5-minute chart. Oh, NASDAQ here. All right, so we'll pay close attention to this now. All right, this should be all set now. Kind of listening in. Just let me know if the volume is good. Alright, how about this? Let's do this. You guys tell me where I should stop, alright?
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress in vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic have shown improvement, but have not fully recovered. Household spending is rising at an especially rapid pace, boosted by the ongoing reopening of the economy and ongoing policy support. The housing sector remains very strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where worldwide shortages of semiconductors have sharply curtailed production so far this year. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and employment rose 850,000 in June, with the leisure and hospitality sector continuing to post notable gains. Nonetheless, the labor market has a ways to go. The unemployment rate in June was 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months, leading to strong gains in employment. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably and will likely remain elevated in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger than anticipated, but as these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal. Very low readings from early in the pandemic, as well as the pass-through of past increases in oil prices to consumer energy prices, also contribute to the increase, although these base effects and energy effects are receding. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of long-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of policy. The effects of the pandemic on the economy have continued to diminish, but risks to the economic outlook remain. Progress on vaccinations has limited the spread of COVID-19. However, the pace of vaccinations has slowed, and the Delta strain of the virus is spreading quickly in some areas. Continued progress on vaccinations would support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency MBS by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition once economic conditions warrant a change. Participants expect that the economy will continue to move toward our standard of substantial further progress. In coming meetings, the committee will again assess the economy's progress toward our goals, and the timing of any change in the pace of our asset purchases will depend on the incoming data. As we've said, we will provide advance notice before making any changes to our purchases. On a final note, we announced the establishment of 2 standing repo facilities, a domestic one for primary dealers and additional banks, and another for foreign and international monetary authorities. These facilities will serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Thank you. Let's go to Steve Leisman with CNBC.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, I don't know, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2% on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation, there's wages, there's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So there isn't. I can't give you a set of numbers, for example, a numerical threshold like we used for a time back in 2012, I guess it was. We didn't do that here. What we said was substantial further progress toward our goals, and what we said was we would keep, effectively, we would give advance warning as we, and more and more clarity as we move forward. And that's what we're going to try to do. So what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're some way away from having had substantial further progress with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
If I could follow up, you talked about one side of the equation. You didn't. Does it mean you feel like you've reached your goal when it comes to the inflation side? Thank you.
So inflation is running well above our 2% objective and has been for a few months, and is expected to run up certainly above our objective for a few months before we believe it'll move back down toward our objective. The question whether we've met that objective formally is really one for the committee to make. I can't do that by myself. But it's clear that at this time, inflation is actually running above 2%, and again, has been and will be, at least we expect it will in coming months before returning down toward our target.
Thank you. And Saphir with Reuters.
Hello, can you hear me? Hello, can you hear me? I'm sorry.
Yes, we can hear you.
I apologize. I just to follow up on the question, I want to ask, is it correct to see this as the start of the advance notice process? Before a taper, and also, can you speak to how the recent surge in COVID factors into your thinking on the taper? Thanks.
So, as you know, we're in a process now where what we said is that as at this meeting and in coming meetings, we're going to be continuing to assess the economy's progress toward our goals and give advance notice. We'll be try to provide additional clarity about our thinking, both in the post-meeting statement and in the minutes and in the public comments that people make. Our approach here has been to be as transparent as we can. We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there. So that's what I would say. In terms of COVID and the Delta strain, I'll say a couple things. Of course, it will have significant health consequences for many, and we need to keep that in mind before we mention and move to the economic questions. This is rising cases in a number of parts of the country, and some forecasts are for them to rise quite significantly. We'll see. What we've seen, though, is with successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave, and we will see whether that is the case with the Delta variety. But it's certainly a not an unreasonable expectation. So it certainly is plausible that people would pull back from some activities because of the risk of infection. Dining out, traveling, some schools might not reopen. We may see economic effects from some of that, or it might weigh on the return to the labor market. Some people might choose. Again, we don't have a strong sense of how that might work out, so we'll just be monitoring it carefully.
Thank you. We'll go to Nick Timros at the Wall Street Journal.
Hi, Chair Powell. Nick Timros at the Wall Street Journal. In your opening statements in March and April, you noted that a transitory rise in inflation above 2% this year would not meet the threshold of moderately exceeding 2% for some time. And I noticed you didn't repeat that qualification last month or today. And so in your view, has the rise in inflation this year met the threshold of moderately exceeding 2% for some time?
That would, again, be a question for the committee, but I would really say the guidance that you're talking about is really the guidance to do with liftoff, right? That's what the guidance is for liftoff. We had to have labor market conditions consistent with full employment, inflation at 2% and on track to run moderately above 2% for some time. It really isn't relevant now. Because we're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. So when we get to that question, when we start to get to the question of liftoff, which we are not at all at now or near now, that's when we'll ask that question. That is when that will become a real question for us.
Great, thank you. Gina Smialek at the New York Times.
Hi, Chair Powell. Thank you for taking our questions. I wonder if you could talk a little bit about reacting. Does that affect how you're thinking about tapering? Does it affect how you're thinking about, potential liftoff down the road? And if you could just talk a little bit about that.
Gina, I'm sorry. For the first 15 seconds of your question, you froze. Could you say that again? I apologize.
Oh, yeah, no, sorry. So I was wondering if you could talk a little bit about how the divergence in global growth and the sort of multi-speed recovery we're seeing around the world impacts how the Fed thinks about its policies. So do you take into account that sort of multi-speed recovery when you're thinking about tapering QE, and do you take it into account when you're thinking about liftoff?
Thanks. So it's an important feature of this recovery is how uneven it is, and in many cases it's related to the fact that some countries have had little in the way of access to vaccines, and so they're seeing significant outbreaks and it's weighing on economic activity, whereas other countries, such as the United States in particular, are having a very strong rebound. And now Europe is having a stronger rebound as well. So it's a feature of our economy. Now, how does it affect our policy? In a couple of ways, potentially. One just is that, in general, economies and through financial markets and through trade are deeply interconnected now. And so a stronger global economy will lead to more U.S. exports, and that'll help economic activity. To the extent the global economy is weak and the United States is strong, we'll wind up exporting some of our demand through imports rather than having a lot of exports. That's one way. Another way, though, is more on the risk side, and that is, as long as COVID is running loose out there, as long as there's time and space for the development of new strains, no one's really finally safe. These strains, there's no reason they just can't keep coming, and one more powerful than the next. We don't know that, but that's certainly a plausible outcome. Now, as vaccinations rise, we can nonetheless get back to our economic activity. But it is both the right thing to do and very much in our interest to make sure that vaccination happens broadly around the world, just for that reason.
Thank you, James at the FT.
Thank you very much. Chair Powell, how would you describe the risk to the outlook on inflation at the moment after the last data came out higher than expected? Do you believe the risks are tilted to the upside? And does the committee share that view, or are they in balance? Are you still worried that there could be a hit to demand from the Delta variant that could tilt them sort of to the downside again? If you could give us a sense of that, that would be very helpful.
Sure, I'd be glad to. So if you look at the most recent inflation report, what you see is that it came in significantly higher than expected, but essentially all of the overshoot can be tied to a handful of categories. It isn't the kind of inflation that's spread broadly across the economy. It's new, used, and rental cars, it's airplane tickets, it's hotels, and it's a couple of other things. And each of those has a story attached to it that is really about the reopening of the economy. So we look at that and we think that those are temporary things because the supply side will respond, the economy will adapt. We have a very adaptable, flexible economy and labor market, and it's a real asset that we have. And so we think that inflation should move down over time. Now, we don't have much confidence, let's say, in the timing of that or the size of the effects in the near term. I would say in the near term that the risks to inflation are probably to the upside. I have some confidence in the medium term that inflation will move back down. Again, it's hard to say when that will be. I will say though that inflation is half of our mandate, price stability is half of our mandate, and if we were to see inflation moving up to levels persistently that were above, significantly, materially above our goal, and particularly if inflation expectations were to move up, we would use our tools to guide inflation back down to 2%. So we won't have an extended period of high inflation. We think that some of it will fall away naturally as the process of reopening the economy moves through, and it could take some time. In any case, we will use our tools over time as appropriate to make sure that we do have inflation that averages 2% over time.
Thank you. Victoria at Political.
Hi, Mr. Chairman. So bond market pricing seems to suggest that investors think the Fed might eventually over-tighten. So my question is, do you think that markets have bought into the central bank's new framework, and how do you balance that with managing inflation concerns?
Well, so in terms of what's been happening in bond markets, I don't think there's a real consensus on what explains the moves between the last meeting and this meeting. We've seen the long-term yields go down significantly. Some of it is a fall in real yields, which may have been connected to, some speculate, connected to sentiment around the spread of the Delta variant and concern about growth. There was also some decline in inflation and compensation, which is significantly reversed. And there are also so-called technical factors, which is where you put things that you can't quite explain. So I don't see in any of that there is really anything that challenges the credibility of our framework, if that's really your question. We are committed to achieving 2% average inflation over time. What we said was that, in particular, when we see a very strong labor market, high levels of employment, low levels of unemployment, that won't be enough for us to raise interest rates until we see some inflation. Of course, what we have today is kind of the opposite. We've got 7 or 8 million fewer people at work than were at work before the pandemic. So we're a ways away from full maximum employment. But we have high inflation, so it's kind of the opposite case, and we have to deal with that. Any central bank has to deal with that by looking at the inflation and asking whether it is broad-based and likely to be persistent, and whether inflation expectations are implicated in a way that could cause them to rise. So we're monitoring that very carefully, and we're prepared to use our tools as appropriate. But again, I think I think our framework is pretty well understood, and I think the real test of it will be down the road when it's time to think about raising interest rates and how we assess that set of issues.
Thank you. We'll go to Rich at Bloomberg.
Thanks very much, Michelle. Chairman Powell, you just alluded to the fact that you're prepared to use your tools to slow the economy down if need be, if inflation looks like it's getting out of control. I want to just try to understand that in the context of the framework and the forward guidance. Does that mean you'd be prepared to raise interest rates even if we're not at maximum employment at that point? Should you see this danger of inflation? And two, does it also mean you'd be prepared to raise interest rates even if you are still buying assets? Thank you.
So there's a part in our statement on longer run goals and monetary policy strategy, which, Rich, I'm sure you're familiar with, which talks about that case in which the two goals are in tension. Most of the time, if you have high inflation, you also have high employment. They tend to go together. This is a situation where they're temporarily in different directions. We're not at full employment, but we are having high inflation. We feel like we're going to be making good progress over the course of the next couple of years, really, toward maximum employment. This is a very strong labor market. If you look at the number of job openings compared to the number of unemployed, we're clearly on a path to a very strong labor market with high participation, low unemployment, high employment, wages moving up across the spectrum. That's the path that we're on, and it shouldn't take that long in macroeconomic time to get there. So that's what I think is really the likely case. Again, it's not timely for us to be thinking about raising interest rates right now. What we're doing is we're looking at our asset purchases and judging what is right for the economy and judging how close we are to substantial further progress, and then tapering after that. And then the question you ask about would we raise rates if we hadn't finished the taper, hypothetical question. We'd face the circumstance at the time. We could always just one thing one could do would be to just cut asset purchases all the way to zero if you wanted to do that. But it's just hard. It's hard to answer what you would do without knowing a lot more about the situation. Ideally, you wouldn't be still buying assets and raising rates because, of course, you're adding accommodation by buying and removing accommodation by raising rates. So that wouldn't be ideal. I'll say that.
Thank you. We'll go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for taking the question. So you talk about jobs. You just said that we're on a path to a very strong job market. We have 9.5 million people unemployed as of the last labor market survey and 9.2 million job openings. So what's the disconnect? Is it a skills gap? Is it the extended unemployment benefits? Is it the fact that people just aren't willing to relocate? What is the disconnect there?
It's a really unusual situation to have the ratio of vacancies to unemployed be this high, and we think there are a number of things at work there. Maybe the place to start is just to say that this is now not so much about people going back to their old jobs. It's about finding a new job. So that's a time-intensive, labor-intensive process. And there may be a bit of a speed limit on that. There's research that suggests that there is a speed limit on that. So it's not like you can have millions of people at the beginning of the recovery going back in a single month because they're just going back to their old jobs. This is about job selection, things like that. There may also be some factors that are holding people back, and this is what surveys say. There are people who are reluctant to go back to work because they still feel exposed to COVID. These could be jobs where there was a lot of interaction with the public, and where perhaps there's a family member who's vulnerable or for whatever reason. There's also caretakers where schools are not fully open and parents are at home or taking care of older people. And there's also been very generous unemployment benefits, which are now rolling off. They'll be fully rolled off in a couple of months, and all of those factors should wane. And we think we should see because of that, we should see strong job creation moving forward. I mean, ultimately, it's unusual to see aspects like the job openings number in a context where there are that many unemployed people. That many job openings would typically suggest a tight labor market. And of course, we hear from businesses all over the country that it's very hard to hire people. And that may be because people are shopping carefully for their next job. I mean, I think the bottom line on this is people want to work. If you look at where labor force participation can get, people will go back to work unless they retire. Some people will retire, but generally speaking, Americans want to work, and they'll find their way into the jobs that they want. It may take some time, though.
Thank you. Rachel Siegel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I wanted to follow up on what you said about there tending to be less in the way of economic implications from each wave of COVID cases. Could you elaborate on what you've seen to that end during previous waves? And then looking forward, how vulnerable is the labor market to the Delta variant? I'm thinking or wondering if you have concerns that jobs that may have come back in travel or tourism could be susceptible if people started reconsidering their travel plans, or if caretakers were suddenly faced with the prospect of schools not reopening. How do you see some of those risks going forward? Thank you so much.
Sure. So if you remember the summer wave last year of COVID, which was largely southern and western states, the economy just performed much better than anyone expected. You know, we were coming off the spring wave where there were a lot of shutdowns, and then this big second wave hit. And I think the natural thing to do is to expect that it would have a real impact on the economy. It was much less than people thought. People learned, what's happened is, first of all, many people are vaccinated. They're going on with their lives. Secondly, we've kind of learned to live with it. A lot of industries have kind of improvised their way around it. Particularly, for example, buying a new home. That process of buying a new home very quickly moved to much more of a virtual process. And so they were able to do that. And other industries as well have gone to takeout and, no contact things. So that can all, it seems like we've learned to handle this. Now, I think people would like to get back to the way things were. And I hope to some extent we will over time. Of course, the big wave we had last winter did have significant employment effects, particularly in hospitality and leisure and other entertainment, other areas with a lot of direct contact. A lot of jobs were lost in that because that was a very strong wave that happened in the winter months last year, just before the vaccines arrived. So with Delta, we're just going to have to watch. Again, with a reasonably high percentage of the country vaccinated and the vaccine apparently being effective. We're not experts on this, but it seems like a good going in estimate would be that the effects will probably be less. There probably won't be significant lockdowns and things like that. But again, those are not decisions for us, or nor is it something we'd be expert in. In terms of the channels, this is kind of speculation, but it just is that people, you could imagine school districts deciding to wait a month or two for the Delta wave to quiet. I'm not saying this will happen, but that it's easy to imagine that. It's also easy to imagine that some people might say, you know what, I'm just gonna wait a couple of months before going back to work. Wouldn't be hard to imagine that happening. If schools don't open, then caretakers have to stay home, and if people don't go back into the labor force, then the job growth won't be as strong. Those kind of things. So it doesn't. Again, sitting here today, not being able to really know the future, it doesn't seem as though the effects will be very large, but there may be effects, and it may be that the effect is to slow the economy down just for a period of months, or not. There are many parts of the country where it might not have an effect, and we're just going to have to see what the economic effects are.
Thank you. Now we'll go to David Gura at NPR.
Thank you, Mr. Chairman. I was going to ask if you've started drafting your Jackson Hole speech, but I'm going to go in a different direction here. Steve Leisman asked you about semantics, and I'm going to take a cue from him and ask you about the term transitory, because I think of you as somebody who so lucidly explained policies and programs in recent months and made a real concerted effort to explain them to the American public as a whole. I wonder about this term and what you would say to people who don't know it definitionally, don't know what it means, and see prices going up and wonder how long they're going to have to wait. So just some broader definition from you, I'd like to hear just about what it means or how you understand it. And quickly as well, you've talked about vaccines a bit, and your colleague in Minneapolis has placed a mandate on vaccinating employees coming back to that Federal Reserve Bank. And I wonder if that's something that you would like to see or expect to see system-wide going forward.
The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example and not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely. So to the extent people are implementing price increases because raw materials are going up or labor costs or something's going up, the question really for inflation really is, does that mean they're going to go up the next year by the same amount? So you're going to be in a process where the inflation process gets going, and that happens because people's expectations about future inflation move up, and we don't think that's happening. There's no evidence that it's happening. All the evidence is that it's not happening. But nonetheless, we have to watch this very carefully because this is, we have two mandates: maximum employment and price stability. Price stability for us means inflation averaging 2% over time, and so we've got to be very careful about that. But I think it's a good point that it's a term. What it really means is temporary. But then you got to understand that it doesn't mean that the increases will be taken back. Some of them will be, but that's not really what it means. In terms of, so we're working virtually here, and we'll be coming back down the road in a couple of months, starting to bring people back here at the Board of Governors in Washington. And, we're going to follow public health guidance and things like that. We really haven't made the fundamental decisions about exactly what that will look like, and it'll depend to some extent on what CDC guidance looks like when we actually do bring people back in.
Thank you.
Thank you. We'll go to Michael McKee at Bloomberg TV.
Chairman, I wanted to ask you a little bit about your taper timeline, in the sense that you said you want a couple more months of data, and the statement says that the Fed is going to use to evaluate the developments in the two markets in jobs and inflation in coming meetings. Does that suggest that we wouldn't see anything before September or November in your meetings? And I know a lot of people on Wall Street have basically felt you're going to lay out your taper plans at Jackson Hole. Is that the plan, or are we not going to see anything until the fall?
So we made any decisions about the timing, and I did not. If I said we're looking at a couple more months of data, I'm not meaning to suggest anything about a particular time at which we might taper, because we really have not made that decision. All I'm saying is that we're not at substantial further progress. There's a range of views on what timing will be appropriate, and those views ultimately track back to people's views about the economy and what will happen as we make progress towards our goal. So that's really what it is, and we will, of course, as we're going to continue to try to provide clarity as appropriate on timing, pace, and composition. But today I've given you what I can give you, because again, this was the first really, I would say, deep dive on the issues of timing, pace, and composition. And it was a good meeting, and but no decisions are made, and I'm just not in a position to give you much guidance, really, any guidance on the actual timing. But I will say we're making progress. We expect further progress, and we expect that if things go well, then we will reach that goal. And when we reach it, and the committee is comfortable that we have reached it, then we'll taper at that point. I really, there's nothing I can say about Jackson Hole. We're in the process of writing that speech, and I am going to give a speech, and but I wouldn't want to say what'll be in there at this point.
Well, if I could follow up, several people have recently noted that the Fed has got the markets working well, and you've got bank loans up. In other words, you've stimulated demand. But savers and companies like insurance companies and pension funds are getting hammered by the low rates, and they're wondering if the balance hasn't started to shift away from benefiting the economy to doing more harm than good.
Asset purchases were just a key part of our response to the critical phase of the crisis. They really helped us restore market function to these key markets, really, which are very, very important to our economy and the global economy. And then they were a big part of creating accommodative financial conditions to support demand. They were strongly needed. It was that commitment to continue asset purchases that provided strong support for the economy and has been a part of the story for why the economy is so strong right now. So we said we would taper when we achieve substantial further progress, and we're going to honor that commitment. I mean, it's and again, we're talking about it right now, and meeting by meeting, and moving in that direction. We will taper when we reach that goal, and we'll provide more clarity on that as we go, as is appropriate.
Thank you. We'll go to Hannah Lang at the American Banker.
Hi, you've been asked a lot previously if the Fed's monetary policy at all contributes to inequality, but I was really curious to know where you think the Fed's regulatory policy lands, particularly if you think that the Fed's bank capital requirements have had the effect of penalizing lower income households seeking loans. Basically, is it possible to achieve the balance of a safe banking system with one that also provides equitable loan access? Thanks.
Well, I think strong capital requirements are essential for banks, particularly for the largest banks. And I think that an undercapitalized banking system, as we've seen, can be a real threat to the economy, and mostly, or to the greatest extent, to people at the lower end of the income spectrum. So if you look back at not this crisis, but the previous one, the banking system was undercapitalized. So higher capital requirements are really a good thing, because they allow banks to weather downturns and continue to perform the functions that they perform. I think it's other tools that we have to, and the Fed has some of these tools, Congress has some of these tools, other agencies have some of these tools to assure or support the wide availability of credit, particularly to low and moderate income communities. So that's CRA. We enforce CRA. We're working on a new CRA proposal right now with the other banking agencies, and we think it's going to be good, and will support the flow of credit to low and moderate income households. It's also the anti-lending discrimination statutes that we enforce. And it's some of the programs that Congress has in place to support the flow of credit to low and moderate income communities. I don't think it's capital standards at all. I think capital standards work the other way. Strong capital is what enables banks to continue to serve their communities, including low and moderate income communities.
Thank you. We'll go to Chris Rugaber at the AP.
Hi, thank you for taking my question. Chair Powell, I guess I wanted to ask about the last when you were before Congress earlier this month. You mentioned, I think, something along the lines of, it won't take too long before we see if you're right about inflation and its temporary aspect. You also mentioned learning a lot more in the next 6 months about the economy. Can you tell us a little more what you mean by that? When do you think you'll get a clean reading on inflation that is free of most of the distortions that we're seeing now?
Right. So with inflation, as I mentioned, we look not just at the headline number, but we look at all the components that go into the calculation of inflation. And if you do that, if you look under the hood, what you see is not that widely across the whole range of goods and services that are in the economy, we're seeing upward pressure on prices. That's not really what we're seeing. What we're seeing is a handful of things that really account for the overshoot of inflation. And as I mentioned, it's things like cars, new, used, and rental cars have moved up in price because of the car shortage, because of the semiconductor shortage. And hotels and airfares have moved back up, but that really just is retracing the very large downward movement in prices that they had before. So that's a big part of why the inflation readings are so high, and those frankly don't carry significant implications in the long run for inflation or for the American economy. So what I said was, we're going to see whether these things. We don't need to see everything do what lumber prices have done. So if you look at lumber prices, they went up and then they went down. So what we want to see is these other things. Do the prices flatten out? Do they actually move down? If they flatten out, then their contribution to inflation becomes zero over time. So that they're not contributing to inflation. And so if we start to see those things happen fairly widely among the things that have really moved up quickly, then they won't all happen at once or happen quickly, but we'll know that our basic understanding of the situation is broadly correct. And I don't think it will take, what I said was, I don't think it'll take a very long time to see whether that's the case. It is probably the case that, frankly, the overall reopening of the economy is going to play out over a period of time. This is a world historical event that the global economy is now reopening. It's not going to happen quickly. It's going to take some time, and it's going to be very uneven, as we discussed before. But I think we will know, when we know. But I don't think it will take that long. I don't want to put a number on it. But I do think that if we see those things happening, we'll know that we have the story basically right.
Thank you. We'll go to Brian Chung at Yahoo Finance.
Sure. Hi, Chairman Powell. Brian Chung, Yahoo Finance. Just wondering if you could provide a little bit more color in terms of how you're thinking about mortgage-backed securities purchases as you inch towards taper. Within the context of home prices continuing to rise, we've heard a lot of people talk about the idea that maybe they'd like to cool off on specifically the MBS purchases. Is that more because of the optics, or is it because there's an observed relationship from the committee's view between MBS purchases under QE and a hot housing market? Thanks.
So a number of participants raised the questions around MBS and tapering at today's meeting, as a matter of fact, and yesterday's meeting. And I'll just say that, generally speaking, I don't think that I think the Treasury and MBS purchases affect financial conditions in very similar ways. There may be modest differences in terms of contribution to housing prices, but it's not something that's big. So where I think we are is there really is little support for the idea of tapering MBS earlier than Treasuries. I think we will taper them at the same time. It seems likely based on where people are now. The idea of reducing MBS purchases at a somewhat faster pace than Treasuries does have some attraction for some people, others not so much, and I think it's something that we'll be continuing to discuss.
Thank you. Let's go to Michael Derby.
Thank you very much. Yeah, so I wanted to ask you about the standing repo facility and get your sense of what you think it will do for market trading conditions, and also kind of in a semi-related point, the reverse repo numbers have just gotten even bigger since you raised the reverse repo rate at the last Fed meeting. And are you concerned to see nearly $1 trillion a day pouring in through that facility?
So, on the standing repo facility, what is it going to do? So, it really is a backstop. So it's set at 25 basis points. So out of the money, and it's there to help address pressures in money markets that could impede the effective implementation of monetary policy. So really, it's to support the functioning of monetary policy and its effectiveness. That's the purpose of it, and it's set up with that purpose in mind. Your question on the RRP. So we think it's doing what it's supposed to do, what we expect of it to do, which is to help provide a floor for money market rates and help ensure that the federal funds rate stays within the target range. It's essentially what's happening is that it just results in a lower aggregate amount of Federal Reserve liabilities that are in banks in the form of reserves and a higher amount of Federal Reserve liabilities in money market funds in the form of overnight RRP balances. So that's all that's really happening there. And we expect it to be high for some time. It's being driven, of course, by the relatively lower quantity of Treasury bills and also the onset of the debt ceiling and the decline in the TGA, things like that. So we don't have a problem with what it's doing. It's kind of doing the job we expected.
And you don't see any issues with like disaggregating, markets from, investing in private money market securities, like the idea that the Fed's footprint in money markets is getting too big. You don't see any issues there?
Not really, not at this point. Private money market funds are choosing to invest because the rates are attractive. At some point, the rates will not be so attractive as the whole rate cluster normalizes, and you'll see it shrink back down.
Okay, thank you.
Thanks. Let's go to Greg Robb at MarketWatch.
Hi, thanks for taking my question. Chair Powell, I was going to go back to inflation a little bit. I'm just kind of surprised by your tone. It seems like you're just sort of warning that if inflation gets too high, the Fed will act. Isn't it true that, a little inflation is good for the economy and that it's somehow maybe we can get the economy out of this sort of place where we're always going to be close to the zero lower bound? Isn't there a good story to tell and you're sort of panicking people?
I certainly don't have that in mind. Look, we, as you know, we're targeting a moderate overshoot of 2% inflation for some time. We want inflation expectations to be centered on 2%. We feel like they may be a little bit below that. So the bigger picture is that that would be a healthy thing. This is a different thing. This is not that. That was the kind of inflation we were thinking about that comes from a very, very strong labor market and a booming economy. Maybe that was the kind of inflation. This is something different. This is really driven by the supply side, which is not able to handle this big spike in demand that we're seeing as the economy reopens with vaccination and fiscal support and monetary policy support. The supply side, just all over the world, you're seeing the same thing, which is it just can't keep up. And there are labor shortages in a lot of places, the same sort of thing. So, there's absolutely no sense of panic. I've explained, I think, several times here today that my best estimate is that this is something that will pass. It's really a shock to the economy that will pass through. If you look at where forecasters are, people who actually write down a forecast for a living, very, very strongly, they see it that way. Now, we're actually responsible for this, though, so we have to take seriously the risk case, which is that inflation will be more persistent, that it might actually move inflation expectations up, and that we might that the kind of things that might require a response. We don't see that now, but we have to be on the alert for it, and people have to understand and believe that we will react if we need to, and we will. But again, it's not my base case. My base case is as I've said repeatedly, is that inflation will move back down. And no, we're not. We have not at all changed our view, and I haven't changed my view that inflation running above 2%, moderately above 2%, is a desirable thing. This is not moderately above 2%. This is well above 2%, but it's also not the kind of inflation we were looking for. This is really driven by a supply side shock.
Thank you.
Thank you. We'll go to Don Lee at the Los Angeles Times for the last question.
Hi, Chair Powell. Wonder if you could talk about wages. Many workers seem to have gotten some good wage gains in recent months. What can workers generally expect going forward? And it doesn't sound like you're concerned about rising wages feeding into broader inflation. Is that right?
So wages have moved up. A lot of that is driven by new hires, and a lot of it is driven at relatively low-paid jobs in the service industries as people come back. So that's not troubling. And we don't see, there is a form of wage inflation that can lead to price inflation, and we're not seeing that right now. And that really is if what we call unit labor costs move up, and which really puts it move up in a way that is hard for companies to manage and puts them in a situation where they have to accept substantially lower margins or raise prices. Now, when it happens gradually, we've seen in a long expansion, sometimes unit labor costs do move up and put some pressure on margins. In a long expansion, that's been happening late in the expansion. That's not a problem either. The problem is if it happens in a way that pushes firms broadly into raising prices. It was called the wage price spiral. We don't see that now. This is something that was a feature of the high inflationary era of the Great Inflation, but it's not a feature now, and we don't see that now. Of course, we'll be watching it, and this is one of the reasons why we're watching so carefully to see whether labor force whether people do come back in and accept jobs. Given the very large number of job openings and the very large number of unemployed people, we'd like to see, some matching going on there so people get back to work. We think labor supply would be a healthy thing. But wages moving up across the spectrum, consistent with inflation and productivity, is a good thing.
Thank you, Chair Powell, and thank you all for coming.
Thanks very much.
All right, so that was quite a conference. Lasted about 55 minutes, but the markets, for the most part, did get a little bit of a rally out of Powell's speech. So after the speech, we actually ended up rallying. Let's see. So this is where he started talking about right here. So we actually ended up jumping another 54 points, up about 37 basis points. And for the S&P, we are up a little bit over 18 basis points. We were much higher. So we did see tech, or NASDAQ, which is healthcare and tech heavy, kind of push higher slightly more than the S&P 500. But for the most part, I've got all the notes. Basically, I'm going to be sharing these in a separate video. I'll be going over, I'll do like a summarized video on what he basically talked about. But for the most part, unchanged policy. So something that we discussed about inflation, of course, running higher. So they're acknowledging that. But interest rates are going to stay where they are, at least for the near-term future until going into 2022, 2023. In terms of taper timeline, he basically mentioned what we were expecting. It's more data-driven as opposed to time-driven, so you don't want to put a pin to a specific date or a time or when they're going to announce that. It's more about when they get to learn more about the economic situation, the growth related to the labor market, and some more inflation readings. That's when they're actually going to start telling us, announce us in advance when they're going to start doing some tapering. There was a very specific type of questions that I thought were interesting. So transitory, what that means. He basically said that that's the concept of inflation, prices increasing year over year, but this is not what it is. Transitory in his book really means that it's temporary in nature, and the process of inflation will eventually stop. So prices won't keep going up indefinitely, but instead this will be like a temporary spike, and then we're going to come back down. And he also mentioned that in the medium term, his belief is that we are going to see a pullback in inflation. So when we kind of look under the hood, this is something that we actually talked about when the CPI readings came out. We talked about the main sort of reasons why inflation has been going up is because of a few things related to used cars we got airfares, we got hotels, we got stay away from home. So those things kind of retracing back up because of an influx of demand with the reopening of the economy, which is what's causing inflation to really move up. But it's not an increase across many goods and services, but have kind of concentrated into specific categories is what he's really talking about. So that's that. Transitory recovered. So substantial further progress. He doesn't really have like a specific data point for us to take a look at. So he wants to take a look at the labor market based on different age groups, based on different demographics, so based on different metrics that are going to be focusing on based on a substantial further progress for him, right? So for the Fed, that's what's really important. So there's not really specific data points. But for the most part, I think it was pretty normal. He said that there's no need to sort of panic, or the policy is going to be very, very accommodative. They are going to potentially look into tapering the MBS first and then move on to the US Treasuries, but right now they are going to do both at the same time, and also not like taper back and raise interest rates simultaneously, because one of them is taking liquidity out, one of them is actually constrained with the liquidity. So when you're raising interest rates, that's more quantitative tightening for the economy, so that you're limiting liquidity from that nature of doing that. So simultaneously, he said that they're not potentially looking into that. They're going to be tapering first, and then they're going to move on to raising interest rates as well in the future. But I will be doing like a separate video going over the summary video and talk about what everything, like bullet point by bullet point, what he basically mentioned. But for the most part, I think it was very normal. Some things that we were expecting from the Fed, and the markets did move up a little bit. So NASDAQ up over 90 basis points. We got the S&P up over 15. So let's check up on the Dow. We haven't looked at it in almost an hour. So the Dow is also up. Actually, this is not the Dow. So Dow is actually down, still down 25 basis points. And this is where we actually have the Fed started talking. So this is where Jerome Powell started talking. We pushed up and then we're back down. So that's interesting. So for the NASDAQ, we actually ended up rallying. The S&P pulled back and the Dow pulled back a little bit more. So that's what we're seeing. NEO up over 6.5%, so hitting high of days. And AMD is also well over $98 now, testing almost 99 bucks, up over 8% on the day. That's a pretty strong move for AMD. But for the most part, all in all, I will put a summary video out very soon. But thank you so much for joining in. It's a little bit past 1 a.m. It's exactly 1 a.m. So you're right on schedule. So thank you so much for joining in. There are earnings coming up, so make sure that you check them out at 1:30 a.m. My time. It's going to be like 4 p.m. Eastern. We got Facebook, PayPal, Shopify, McDonald's reporting their earnings. I will be putting out separate videos kind of going over what my expectations are for those as well. So I hope you enjoyed the live stream. If you did, please make sure to drop a like. I really appreciate you guys. And I will be doing some market updates moving forward as well. So thank you so much for this, joining in. Appreciate you guys. And as always, happy investing. I will see you guys in the next live stream. Peace. Good night.